What's going on, guys? Welcome back to The Country Investor. My name is Robert, if this is your first time tuning in. So what we're going to be doing today, we're going to be diving into the stock market, just kind of describing and going over the basic ways you can invest in the stock market. We're going to kind of break down what they are and how they work. I've left a couple out, but I've taken out some of the most important ones and put them on this list. Also, really quickly, guys, I got to ask you guys to please like, share, and subscribe on this video. Turn on your notifications if you're interested in finance. That's what this channel is about, is to help people make money. Also, I do teach courses on Skillshare, Teachable, and Udemy. Those will be linked down below. I'm going to be doing a full course on different types of investing, not only stock market investing, but real estate, crypto, all that stuff. Is going to be in the course. It's going to be uploaded probably in about 2 days from seeing this video. So definitely check out my Skillshare. Most of my videos do go on Skillshare. A couple do go on Udemy. Also, if you're interested in outdoors, I have another channel called Carrasco Ranch. It's all about outdoors and vacations and trips like that. So check it out if you're interested in that kind of stuff. But yeah, without further ado, guys, we're going to get into this video. And if you're interested in keeping up with me, you can also follow me on Carrasco Ranch on Instagram. I post there, probably about weekly, maybe even sometimes twice a week. Just depends on what I'm doing. So check it out if you're interested in following me. Real quick disclaimer, this isn't financial advice, but it's just to kind of help identify what the stock market is and what composes the stock market, and also the different ways to invest in the stock market. So right off the bat, what is the stock market? The stock market is publicly traded companies that collect capital from investors to use towards their businesses. There's different types of, there's traditional stocks like your Apple, your Tesla, individual companies. Then you also have index funds, which is comprised of, say, the top 10 energy companies or the top 10 car manufacturers, just things like that. So basically, it reduces your volatility because you're basing that cost over the success or the non-success of those 10 companies. So if one company fails, you still have 9 other companies to pick you back up. Same thing goes, there's REITs, which is for real estate. It's like an index fund for real estate. The top 10, developers or whatever can form their own little REIT or index fund, as you want to call it. So just to kind of go over the stock market does fluctuate based on how we're doing as an economy, how individual companies are doing. Everything's going to fluctuate from time to time. But overall, the stock market has always returned positive returns over the long term. So this isn't going to be basically a day trading video. It's going to be more based for longer term It's going to be based more for longer term investors that are not usually typically trying to hold for a day or two. The stock market on average over the longer course of time has typically returned about 7%. Some years are better, some years are worse, but the average is more or less, it hangs around the 7% mark. So if you have money in there, you can kind of calculate how much you will have in, say, 10 years, 20 years, etc. So just to kind of identify what we're going to be covering in this course, we're going to be going over longs and shorts, or puts and calls. We're going to be going over dividend investing. We're going to be going over some day trading, just basically what it is, and index funds, and then long-term, buy and hold strategies. Okay, so the first one on the list is going to be just buy and hold strategy. What is a buy and hold? This is probably the easiest way for beginners to enter the stock market. Basically, all you do is you do some research. You look at what company you would like to buy in. What do you have interest in? That's what I would kind of recommend. Again, not financial advice. I'm not a financial advisor. But if there's a company out there that I like, say you like Pepsi, so PepsiCo. Say you like Pepsi, you want to invest in PepsiCo. If you want to invest you believe in the company and you think this is going to be a company that's going to be here for 5, 10, 20, 30 years, then you want to put some money into PepsiCo. What you do is you buy it, you hold it, you sell it, whenever you're ready to retire or whenever you need cash. So that's kind of what is identified by the buy and hold strategy, is basically identify companies you would like to purchase, that you've heard of, that you truly believe in. You buy the companies, you hold them for a long period of time, and when you're ready to cash out, you cash out. So the next thing we're going to talk about is index fund investing. So what is an index? An index is It's comprised of the top 5, 10, 20 companies, and they collectively create one index or one stock, as you could say. So say you got the 10 largest energy sectors, you got ExxonMobil, Shell, all those places, all those businesses into one stock. So now you buy that one stock, but you're getting exposure to those top 10 companies in that sector. What this does is it reduces your volatility. It reduces your risk tolerance. So if you're a new investor, that's what I would recommend, is you looking into index funds, because when you're new, it's going to be a little scary if you see some fluctuations versus the index funds. They tend to move a lot less because that index fund is based off of how the top 10 companies are performing, not just based off of one company. So for instance, let's just say ExxonMobil had some kind of crazy thing that came out in the news, some kind of, I don't know, fraud or whatever. They don't, as far as I know, they don't have anything like that. But let's just say that happens, right? So there's some type of fraud. Well, now the company is starting to drop in value as on the stock market. So because people are freaking out, maybe they're going to go for bankruptcy, who knows, right? So now people are freaking out. So now the stock is starting to climb down. So if you invested just specifically in that company, now your share value is going to drop as well. Versus if you buy an index fund that had that company in there along with the other 9, now that index fund may drop some because that company is in the index fund, but it's not going to drop tremendously like you would if you had bought that individual stock for that company, because now you have the other 9 companies kind of holding up the bar so it doesn't fall too far. So that's the good thing with index funds. They help protect you against some form of risk. But again, it's not guaranteed. So only risk what you're willing to lose. So the next thing we're going to talk about is day trading. So we're not going to go too deep into day trading, but basically what it is you buy a stock and you hold it for minutes, seconds, sometimes even just a day. There is something called swing trading where you hold it for a couple days, maybe even a couple weeks, and then you trade it. There's different strategies for that. So basically day trading is a lot more technical. You're looking at charts and graphs. You're trying to basically, in my opinion, do a best guess analysis of when you think that company or that share price might drop, go up, drop, and go up. Of course, you're trying to buy low, sell high. Common, you probably heard that before. So day trading is different because you're not typically looking for the value of the company. It's not a company you particularly believe in or even know sometimes. Sometimes it's just whatever is hot at the moment. That's what you usually day trade. So day trading is actually something I had started off with when I first started investing, thinking I knew what I was doing. Didn't know what I was doing, lost everything. So yeah, day trading isn't something I would recommend if you're a beginner. Like I said, the index funds are probably more suitable for a beginner to not leave such a bad taste in your mouth if you're new to investing. So the next type of investing you can do with the stock market is what they call dividend investing. So what dividend investing is so there's a couple companies that pay dividends. Dividends are profits that the company earned in that quarter, in that year. They pay back to shareholders or investors. That's dividend investing. There's a couple companies out there that do that at a higher rate than most. And that would be like companies like Apple, Procter & Gamble, things like that. So you're going to go and click on the tinker symbol like AT&T, Procter & Gamble's tinker symbol. You're going to be looking at how much dividends they pay out. Some pay out quarterly, some pay out monthly, some pay out yearly. It just depends on the company itself. But it's basically a passive way to invest. You kind of put your money in there, and they pay you quarterly, annually, whatever. That's just looking for like the highest yield. But it's a lot of like blue chip companies that do dividend give backs. So for example, you buy AT&T. Say they're paying a dividend of 25 cents per share, quarterly or whatever. So if you have 10 shares, you'll be getting, $2.50 per quarter or annually, depending on how they distribute. With dividend investing, yes, you are earning dividends either quarterly or yearly, but you're also subject to the volatility of that specific stock. So if, say, AT&T again goes up, then you'll be making more money on top of your dividends that you're earning. But if, say, AT&T goes down, now you lost value on that stock, so you may have lost money. So just keep that in mind. Okay, so the last ones we're going to cover is going to be puts and calls, or long and shorts. Those terms are kind of used inversely. So what is a long? A long or a call is basically an options contract. So say Tesla is at, just for reference, let's just say $100. It's simple math, right? Say Tesla's at $100 today. With a long or a call, what it does is you're going to put a long call, say for a month from now, say at $120. So if Tesla is at, say, $150, $160 in a month from now, but your long or your call was at $120, you have the option, that's what it's called, options contract, to buy those Tesla shares at $120. So each contract is worth 100 shares. You have control over 100 shares of Tesla per contract. So you have that option to buy those Tesla shares at $120 when they're actually at $150, $160. So for simple math, if they are at $160, you would make $40 per share for the Tesla contract. So you would do $40 times 100 because you have control of 100 shares for that one contract. So you would do 40 times 100, and that's how much profit you would have made from the contract, from the options contract, minus your options cost again. It varies, sometimes $1 something, $2, $6 for the contract or the shares. It just depends where it's at. All right, so let's say that the option contract went actually in the opposite direction. So say you had that contract to purchase Tesla shares at $120, but in a month from now it's actually at $100. That's why it's called an option contract. You have the right to exercise that contract and purchase Tesla shares at $120. But if it's at $100 currently, you wouldn't pay $120 for a stock that's currently at $100. So what it gives you the option to do is you can sell that contract to somebody else, and without exercising it. So you can just sell it. Sometimes you may come out with a loss, sometimes a profit. It just depends how much people are willing to pay for that contract at this specific time. So keep that in mind. You can lose a lot of money this way as well because you are basically in control of 100 shares per contract. So you're kind of leveraging your money in a sense. Okay, so now the last one, we're going to be talking about shorts or puts. So what a short or a put is basically you think the company's going to do worse in a month from now, or wherever the short is, a year from now, 2 years from now, months from now. You think the company's going to do worse than where it is today. A long is the opposite. You think the company's going to do better than where it is today. So a short basically is going to be, say Tesla is currently at $100, and you buy a short for Tesla a month from now for $80. So you're thinking Tesla's going to drop $20 from today's date and a month from now. You think it's going to drop $20. So let's just say Tesla does drop. Say in a month from now, Tesla goes down from $100, they go down to $60. So now you have the option to purchase Tesla shares at $60. You can purchase the 100 shares at $60. So if they are now at $60 and you had their strike price, by the way, it's called a strike price. I think I forgot to mention that. A strike price of $80 in a month from now. Now you have the option to buy those shares at $60, and you would profit $20 per share on that contract. So $20 times 100 shares because you have one contract. So whenever you're doing puts and calls like that, your strike price is going to be the price you think it's going to be at in that specific date or time. That's going to be your break-even price. So anything above it or below it, you're going to either make money or lose money. Okay, so now back to shorts. So let's just say, again, you bought it at $100 today. you were betting it was going to hit $80 a month from now, but it's actually at $120. So that actually works kind of opposite how you would think of things, because you did buy a call or a put. You would want it to go down. If it goes up, you've actually lost money. When it goes down, you make money on a call. So in this case, it's at $120. You had your strike price at 80. So now you've lost money. So now you have the option to either purchase the Tesla shares at that price, or you can either sell that contract. So obviously you'd want to sell the contract instead of exercise your contract. Because you were betting that the company was going to be doing worse, but it actually ended up doing better, you kind of lost money in that gamble, in that put call. Alright guys, so I know that was a lot of information. Trust me, it was mind-boggling when I first dove into all this stuff myself, but I've kind of taught myself over time. So just break it down, guys. Just break it down. If you have to rewind the video, take down notes, whatever you need to do to kind of help remember some of this stuff. But like I said, I hope it helps somebody out there. But again, without further ado, appreciate you guys watching. Until next time, be careful, be good, take care, and God bless. And we'll see you guys later. Bye-bye.